Hello, my name is Will Deere and I'm an investment specialist at Wilson Asset Management. I'm joined today by Oscar Oberg, who is the lead portfolio manager of WAM Capital, WAM Active, WAM Research and WAM Microcap. Thank you, Oscar.
Thanks, Will. Thanks for having me.
We've recently raised $90 million from existing shareholders in WAM Microcap. Can you talk about how you're deploying that? Have you started deploying it? Are you still seeing opportunities?
Yeah, look, first thing I should say is overwhelmed by the support of our shareholders. So really appreciate the fact you've supported us with that capital raise, because it did come at a time when the markets were a bit wobbly. But in terms of deploying the proceeds, the $90 million, we're taking our time. The market is a little bit uncertain at the moment. There's definitely no rush. But if I had to put a number to it, we've probably deployed around a third of that money to date. So we're sitting at a little bit higher cash levels than what we normally have over the last few years.
Thank you. And you've spoken previously about this disparity in valuation in small caps, and you've been quoted as saying small caps are back. How are things going currently with regards to that?
They were back. It's interesting. The tide can turn pretty quickly these days, and I think when we're sitting at the time of the roadshows back in April, and certainly we'd had a really good February-March period coming out of our reporting season. I think small cap industrials at that point in time were outperforming the broader market financial year to date by around 4%, and now they're underperforming by 1%. So if that continues, it'll be the third financial year in a row where small industrials index has been the worst index in the market. Now, for us, that's, while it is a negative and small caps have had a tougher time of late, it is bringing up lots and lots of opportunities, and particularly in that micro cap space where we're seeing a number of companies trading at big discounts to the net tangible assets. We see a lot of companies with very, very strong balance sheets that because they're illiquid, they're getting sold off quite heavily. That puts, from the micro cap perspective, exciting times ahead, and we just need the markets to effectively just stabilise. We don't necessarily need interest rate cuts. We just need the perception of the interest rate increases to normalise, and I think the stock picking will come through, which is what we've seen with all the funds really this financial year so far.
And do you think we'll get more clarity on interest rates? If interest rates are important for the small cap landscape, when do you think interest rates will start falling? I know it's not an important input in your process, but it's clearly important for sentiment around small caps.
Oh, it's definitely important for sentiment, and I think the thing you've always got to remember with the small cap market is way the overall index or the benchmark looks these days in the small ordinaries index, because a lot of the retailers and the automotive companies their market caps have fallen. They're actually in our index, so it is a big part of our index. It's around 30 to 35% is in companies exposed to the consumer in sectors such as retail, auto, housing, etc. So you do need that stability or confidence on interest rates. Are we there yet? I don't think so. I think the positive thing, so while small caps have been weak through this period, and certainly there have been a number of updates, particularly we saw that through the Macquarie conference, it does feel, and we have the luxury of meeting a lot of companies, and we see a lot of companies, we do thousands of meetings every year. It does feel, or the overall sentiment in the last probably 6 weeks or so has shifted downwards.
Right.
In terms of for what that means for Australia, it feels like the path we're on at the moment feels about right. There has been some CPI increases a bit higher than what people had thought, but when we see companies at the moment, particularly those exposed to consumer, it is getting a bit tougher, which ultimately, while it's negative for near-term earnings, it's probably positive from an interest rate perspective as we look forward.
And have you stuck with your winners, or are you trimming the winners and the ones that you've had some phenomenal performance? Are you tending to stay with those that have delivered, or is it now time to take profits and move on to other opportunities?
Yeah, I'd say broadly the portfolio, if I look at all the portfolios really, hasn't really changed that much over the last 6 to 12 months. We're all, part of the Wilson Asset Management process is that we are an active fund manager, so we're always taking, every day we're buying and selling shares depending on where our view on the valuation is or the current share price versus expectations. So there has been a few changes. I think the biggest change to the portfolio, and this is consistent across all of them, was around February, March. We did have a very good period, and as I was sitting there looking at the portfolio and speaking to the team, we did realise we're quite overweight the consumer sector, and that had been a key overweight for us really since around April, May of 2023. So it was a trade that lasted probably 9 months or so. So we did sell a lot of those companies through that period, which ultimately looks like it was the right call. But I'm not going to sit here and say we got out of all of them. We're still getting hurt by some of the ones that we still have. But when it comes down to it, we're still very confident in the long-term projections of the company. It just might have a tougher period over the next few months or so.
Is it fair to say that the portfolio is more defensive, where you could take that cyclicality out? You've made it slightly more defensive for this environment?
Not particularly. I think the interesting thing, that the dynamic that you have at the moment is you have and I hate talking macro because I'm not macro. I'm around stock picking. But interestingly enough, if you thought that the perception was that interest rates would be increasing or inflation increasing, you wouldn't have thought the tech industry would be doing so well. But it is still going well, and it's of course of artificial intelligence and all the spending that we continue to see in the sector. So, if we were being defensive, a lot of those tech names would probably have been sold quite heavily. But we've actually held a good weight in those companies. Definitely sold down our consumer discretionary exposure, which has been good. We've still got an exposure there, but again, as I said, companies like Nick Scali, Premier, Universal, Beacon Lighting, we've got a very positive view of those businesses over the medium to longer term. So we're happy to hold those positions through this current weakness. So I wouldn't say the portfolio is defensive. I just think it's very much it's what we're good at, which is stock picking. Sure. And so I'd say there's no real themes across the portfolio, let's call it, at this juncture, where there probably was around 6 to 9 months ago when we definitely had a bet on the consumer.
A clear differentiator for Wilson Asset Management is the importance of catalysts, identifying catalysts to effectively avoid value traps, essentially. Can you give us some examples of catalysts that you look for different companies in different sectors?
Yeah, I mean, look, catalyst is anything that just changes the perception of the share price. So catalyst could be an upgrade to earnings, it could be an acquisition, it could be a divestment or something like that. Probably the best example, the process really over the course of the years, been Sigma Pharmaceuticals, which of course has done the Chemist Warehouse transaction. We'd been in the company for around 2 years. We owned around just under 5% of the company. It was actually at the time we were buying the shares, Homeco were buying the shares, and having done work on Homeco, there was a family interest, let's call it, with the Chemist Warehouse guys. So you were sort of questioning at that time whether something was going on there. But in the end, we liked the new CEO of Sigma Pharmaceuticals. We thought they would beat earnings, which they did. We thought they would win the Chemist Warehouse contract because they had much more newer facilities, and they needed the contract, let's call it, much more than their competitors, so they were willing to discount their price. And so when they won the contract, that was a significant catalyst to the company. And then after they won the contract, you kept hearing news reports of, in the press saying things about Chemist Warehouse and so forth. And we held on to the shares, and then lo and behold, the Chemist Warehouse merger occurred, let's call it, in November. And I think at that point, you sort of go, okay, the shares have gone up. What's the next catalyst? Well, the next catalyst was actually Sigma entering the ASX 200. Right. And that sent the shares from about $1 to $1.30. But, as you talked about previously, that was a massive weight in the portfolio, which we've progressively sold down over the last 6 months into profits. But it's probably been our most successful stock, let's call it, over the last year or so.
Okay, thank you. And in terms of things that have gone well that you're really pleased about, can you just give an example of a stock that had a prolonged period of maybe underperformance, but you've stuck with it and it's come good?
Oh, there's plenty in the portfolio that probably haven't come good yet. But right. I mean, look, the best. I think the best. I'll say a sector because we've gone from one of the stocks that got taken over, and just as soon as it got taken over, we just bought the peer. Was the aged care sector. And so Estia Health, we were lucky enough to have that. We had, I think, around 10% of the company. It was the biggest weight in the portfolio. It's probably the biggest takeover we've ever had in my time at Wilson Asset Management in terms of the weighting of the portfolio. And that got taken over by Bain in May of last year. And fortuitously, when we got the cash from Estia, because we'd done all the work on Estia, and we battled with that stock for years. Like I'd say 3 years, right. Absolute battle. It didn't move for the same share price for 3 years, despite the market going up a lot, and then there was a takeover. And then Regis, their competitor, which actually has high quality aged care centres than Estia, was just sitting there, and we took the money from Estia and just put it into Regis, and shares have more than doubled over the last year. And that's been a function of a lot of the work we've done, understanding the problems in Australia with aged care and the fact that government needs to fund a lot of the wage increases and to allow the industry to, following the Royal Commission, to actually turn a profit and actually get new investment. So you see a very favourable industry dynamic emerging with the industry, and that's now come through with Estia and both Regis. And we're actually one of the stocks we've battled with for well over a year is G8 Education in childcare, and tonight we've got the budget, so fingers crossed. Mm-hmm. Hopefully, when the viewers see it, it comes through. But we actually think there's a chance that the government might fund the wage increases or the award wage increase, which is rumoured to be about 25% for the childcare industry. That would be enormous for G8 because it's probably the first time in a decade where the business can actually generate some operating leverage. So. We always have stocks like that where you're sitting there for a rainy day waiting for them to finally come good, and when you're a big fund like us, you've got to take early bets, so that's certainly part of the process of what we do.
And are you expecting continued M&A activity? It sounds as though valuation can be your catalyst. Good quality businesses don't stay cheap forever. Are you expecting that to continue as a theme in the Australian market?
Definitely. I think it was crazy, like I would say. I've never seen anything like it. That 6-month period from September last year to the end of March was nuts. Like right. There was something every Monday. There was a day where Adelaide Brighton, Link, and Pacific Smiles, a dental roll up, all got done on the one day. Like I've never seen that before. Now the macro environment's changed a little bit now. There is some uncertainty around interest rates. There's a bit of uncertainty around the economy. The small cap market's underperformed the large cap market. So I think we'll see that pause for a little bit. Mm-hmm. Now, in saying that though, on the micro cap side, I mean, there's just so many companies out there that are trading at ridiculous valuations, and because there's no liquidity and there's just no demand for the shares. So look, I can still see some of those companies being taken over. I just don't think we'll see the same quantity that we've seen over the last 6-month period, which, to be frank, has been, I think it's a decade high in terms of what we've seen. So. It'll be interesting to see how it pans out, but I'm making an early call on that because it hasn't panned out. It's actually still been very positive, but I do think it'll calm down a little bit.
You've said previously that when other fund managers start to move down the market cap spectrum, that you'll start to see a lot of these small caps re-rate. What do you think those fund managers need to see before they start adding to their weights in small caps?
Oh, it's simple. I think it's stability in the macroeconomic environment. Like if you're a large cap fund manager, right, and you're looking at your big fund and you say, I need to own a retailer, right? You can either buy Wesfarmers or if you want to go defensive, go Woolworths and Coles. But when you buy those businesses, you've got an exit in case it doesn't work out. Now, if you take that portion of money and you start going, okay, I'm going to buy Premier or Nick Scali or, and you want to buy 5% of the company, if you get it wrong, it's going to be very difficult to come out. Mm-hmm. And I think liquidity is at a premium in markets such as what we're in at the moment, and certainly what we've seen over the last 6 weeks. Small caps have underperformed the market, but the large cap companies, if anything, keep getting stronger. Like Wesfarmers, for instance, I had a look at the other day, and it's a great company, isn't it? Amazing story, Kmart, Bunnings, etc. But it's trading on a price earnings multiple of close to 30 times earnings. Wow. Yeah. I couldn't tell you any companies in small caps like that. I mean, I could buy a retailer today at 10, but it probably goes cheaper to 8. Whereas Wesfarmers probably will hold its valuation and keep growing if the market keeps going up. So you need risk. You need risk appetite to increase. Right. And I think that happens when the macroeconomic environment stabilises. And look, we saw an example of that happening from around November to March, and it was a great period for small caps. Yeah. It was not very long period. So we're hoping that at some point in the next year or two, you will get an extended period like that, because the underperformance of small and large it's actually getting wider. Right. So it sounds like there's huge opportunities out there, but one needs to be patient. Is that exactly right? Thanks very much, Oscar. Great to chat. Thanks for your time, and thanks for watching.